Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So most people, and a lot of them are still doing it, and they're talking about secular trends. A lot of people that talk about trends that last long periods of time. The gold bear market from 1980 to 1999, approximately 19 years in length. The current secular bull market in gold from 2000, which is projected to go to 2019, because it's probably going to match the length of the bear. Okay, secular trends, that's beautiful. They last a long time. However, most people need to trade more actively than once every 25 years or once every 20 years. So a lot of the analysis that's out there that talks about these secular trends kind of keeps people focusing on that trend. And unfortunately, if you're constantly bearish on the gold market for the last 10 years anyway, you've been losing massive amounts of money. And there's people that are still bearish on the Dow, and they say it's going to go down and make a new low before the end of this secular bear. And they could absolutely be right. But the problem is there's going to be several cyclical trends prior to that. And for me, I would rather trade those trends because I can make money when we have a sideways market that goes up and then a sideways market that goes down. So when the economy has four stages, such as expansion, peak, contraction, and trough, the stock market, the currency markets, the bond market all have a similar cycle. And all of them move at different times. Certain sectors of the economy respond better to rising inflation. Other sectors respond better to falling inflation. So money goes in and out of these sectors depending on where we are in this cycle. So, for example, the current market rally that we're having in the Dow Jones, which is again starting to rally ever since last month, it has managed to go through a mini cycle, very, very big sell-off followed by an accumulation, once again a markup. And just a couple of weeks ago, everyone was talking about a potential double top and a reversal. Okay, so this is going to be a cycle that repeats on every time frame. Of course, I'm looking at it on the weekly charts and I'm paying attention to it. So right now we broke out of that resistance and we're starting to make a new high in those markets. So this market now, it looks like it wants to go higher. And here, this chart always shows you that the bottom of the economy in yellow, the trough, was officially declared just a month ago. So finally they declared an end to the last recession. And when they declared the end to the last recession and we look at this chart, we can see that already the stock market has managed to rally probably 60-70%. And when it rallied 67%, it went through a few sectors that were popular. So we had the sectors for technology, we had the sectors for financials because they were beaten down as bad as they were, and usually you're going to see the transportation sector lead the economy and move higher. So we're moving through this bull market, and the stock market is rallying 70-80%, but in the meantime, it looks like the economy is just beginning to bottom. So that means that you're going to be pretty bearish when the market turns, currency markets, stock markets, and at the top, you're going to be very bullish when the economy turns and the market turns lower. All right, so what happens is I'm going to combine the information I have about trends with potential areas where markets can turn based on price, past areas of price resistance and support, or price areas of demand and supply. So when I have a stage one accumulation, it's usually because I come into some kind of past price support. And then prices usually go sideways for a period of time, and all the institutions accumulate large positions. All of the people that are losing money sell out, And eventually, when you run out of sellers at that price level, you break out into the next uptrend. After an uptrend, usually when the market is basing again after a period of strong uptrend, you have the potential for a breakout to the downside. But on the next chart here, you can see that the dollar index, which is the basket of currencies against the euro, the yen, the pound, the Swiss franc, the krona, we rallied up into an area of past price resistance back in from 2006, and we actually had two stage 3 tops very close to each other. And that led to a stage 4 decline, and we came back down to the bottom of the chart here, and we had an accumulation phase once again in the same place that we had the past accumulation phase from 2008. And then we had another up leg in the dollar, which nobody believed last year at this time. And then we topped out and we turned around and we dropped again. Well, I want you to notice that the dollar is very, very close once again to the area where last year's rally started. And so there's a potential for the dollar, at least temporarily, to find some support. Okay, so the 4 stages reviewed again. Primary trend after we break out of the accumulation phase becomes up. Okay, we manage to make new highs, or we pull back to the trend line, the rising trend line, for a buying opportunity. So that's what I mean. You can either make a new high, or you can pull back to a trend line and you get a buying opportunity in an uptrend. And anybody that buys in an uptrend usually makes money. When we get up to the top phase here, the distribution phase, once again, prices move sideways. There's indecision in the market. And this is usually where institutions begin to unload large positions to the public, who's all confident that, you know, this is the best time to buy the market. It's finally moving up. And then if that happens, we break out to the downside. We start the downtrend, which is primarily down with some intermediate term, short-term rallies. And that's when people try to pick bottoms. And usually what happens is we break down and make new lows until the bear finally goes down to the phase where accumulation starts all over again. But this slide says it doesn't have to be that way. There is a possibility that new information can enter the market, and instead of having a reversal, we can have an accumulation at a higher price level and a breakout to the upside, which means we have a new uptrend. So the pattern, instead of being 1, 2, 3, 4, and it's never set in stone, it has the potential to be accumulation markup, and then another accumulation and a new uptrend. So at this point in time, when you look at this, you say to yourself, okay, how do I know what it's going to do? How can I predict? And this is the only thing, if I was going to change anything about my webinars, is I don't really try to predict anything. If it breaks out to the upside, it's an uptrend. Now I react. I just continue to buy new highs, or I buy pullbacks to some kind of trend line support. If it breaks out to the downside, I react. I start shorting rallies, or I start shorting when price makes a new low. And so rather than predict, let's be more reactive.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.